Welcome back. Well, we spoke about the technicals of the markets. It's time to discuss fundamentals. Vinay Paharia from PGIM India Mutual Fund is joining us now. Vinay, good morning. Thank you so much for joining in. But I was going through a report and it suggests that the market now seems to be turning in favor of high growth and high quality companies. What have the returns been like? Because this year, this fiscal at least, has been very volatile. If we talk about the benchmarks, a lot has happened in terms of macros, be it political issues as well, elections. So how do the returns compare for growth companies versus companies which are neither growth nor quality?
Hi, good morning, Sonal. Thanks for having me on the show. So, Sonal, as you rightly said, there has been significant volatility in this year. On the surface, market has corrected post-elections, post-BOJ's decision, but has continued to make fresh highs. But as I said, it is all on surface. Underneath, there is a big churn which is happening in the market. In the last 1 year, starting April 2023, we saw low-quality companies and low-growth companies deliver substantially higher returns compared to high-quality and high-growth companies. So the magnitude of outperformance of such low-quality companies was almost to the tune of 35% in the last 1 year or so. Starting post-election or maybe first week of June onwards, we have seen this big churn, which has accelerated in August. And based on our estimates, the broad outperformance of good quality and high growth companies over the low growth and low quality companies is approximately 10% in this period. So there is a clear churn which is happening in the market.
So how does one best play this in terms of mutual fund exposure, in terms of should one be having a large cap oriented portfolio? If money has to go in, fresh money, would you put it in large caps? What about any of the themes? Should one go for IT, a thematic IT sector portfolio, or pharma, FMCG? What's the advice for retail shareholders who are playing the market via the SIP route? So what would their mutual fund exposure be?
Hi, Reema. So I think one of the ways, and it is painful ways, is to start allocating some bit of money to underperformers of last year, because most of the funds or companies which have done well in the last 1 year's time are companies which are either low quality or low growth companies. And hence, these have started underperforming now. Whereas what underperformed in the previous year has started outperforming since June onwards. So I think a simple measure of doing that is to start diversifying your portfolios away from some of the strong outperformers of the last 1 year. If you talk about capitalizations, I think the gap is within the capitalization as well. So if you look at either large cap, mid cap, or small cap, we saw the same trend across all capitalizations, and hence diversifying by capitalization may not be a very, very useful strategy. They only have to start adding some of the underperformers of the last 1 year to start diversifying their portfolios.
Okay. Vinay, do you think, or tell us, what would the next big trigger for the market be? Is it just the rate cut that the entire market is looking at?
I think, Sonal, we should not look for many more triggers. The market has already appreciated quite significantly. We have borrowed some returns from the future. So I think the best trigger would be the market stays on course, looks at the underlying earnings growth. That's it. I think the economy is doing reasonably well. So if the market consolidates at these levels, I think that would be a best case scenario. And also, we think that the big trigger for growth companies would be interest rate cuts, and they are already being expected. So clearly, our thought process is that the growth companies and quality companies should start outperforming most of these low quality, low growth ones post the interest rate cuts.
Okay, fair enough. What about the broader call on the markets per se at the index level for the next 6 months? Because we are entering a seasonally weaker period for global markets. There's uncertainty surrounding US presidential elections. Q1 earnings were a bit subdued. So it's not that we've seen any kind of EPS upgrades or they're likely perhaps in the next 3 quarters. What's the broader call for the next 6 months?
We would imagine that the market would ideally go through a phase of time correction for the simple reason that we have already run up ahead of fundamentals. The market returns over the last few years is much higher than the underlying earnings growth, and hence the market needs to take some breather for the earnings to catch up so that the valuations become much more palatable.
But given the kind of wall of liquidity that's gushing in, there hasn't been a correction. The corrections have been limited to about 2%, 3%. An earlier guest told us this week that, now there is no longer the 10%. What used to be a 10% correction is now at best a 5% correction. That's the kind of market we're in.
I think people who would have seen the markets for the last 25 years would not want to comment on such a short-term phenomenon. Liquidity is strong, but remember, the same liquidity, which is a virtuous cycle today, can also be a vicious cycle whenever the tide turns out. So I would just say that we just should ensure that we are not just dancing up right up to the clock strikes 12 and everything turns into mice and pumpkins. So we need to be very, very careful, especially in heady days like the times which we are seeing right now. We have seen many such phases in the last 25, 30 years, and hence I don't want that history should repeat itself, but we need to remember, while history doesn't repeat, it rhymes.
So, since we are in heady days right now, Vinay, what kind of cash levels are you sitting on, and at what level would you be comfortable at deploying it back into the markets?
So we typically do not take any cash calls, Sonal, because we are mandated by our investors to remain invested in equity. But as we discussed right at the start of the show, we are invested in companies which have actually underperformed in the last 1 year's rally. And most of these companies have delivered very strong earnings growth. And these companies are not extremely overvalued as most other segments of the market, which we call them as micro bubbles. So we are invested in a part of the market which we think is reasonably well valued. Plus, the underlying intrinsic value growth in those segments of the market is very, very strong. And historically, the returns have followed the intrinsic value. So we think that over a 3 to 5 year period, investors in our fund should ideally also do reasonably well.
Okay. All right. Vinay, thank you so much for joining in today with your take and market fundamentals as well. That's the word coming in from PGIM Mutual Fund. Heady days for the market, so it's time to be very, very cautious. That's been the view of a lot of fund managers generally as well. But time for a short break. Abhishek Kapoor from Purvankara will join us on the other side to discuss the business outlook and the latest redevelopment opportunities that the company has entered into.